Joyce, you were so early in calling on this global capex retrenchment. Are you seeing any signs now that it's beginning to bottom out?
Well, the manufacturing numbers are coming in weak, and what we're really focused on is the consumer numbers. I mean, the consumer data was growing very fast in the first half at 5.5%, and now it's down to 2.5%. Unemployment also has hit these record lows, but we're actually seeing just some more questions about unemployment and consumer going forward, while the manufacturing still seems to be soft, particularly out of Europe.
So are you on alert for disappointments in non-farm, or is it too early for that?
I think it's a little bit early for that, but I think what the market is really focused on near term is U.S.-China. Is there going to be a phase one deal, and some of the no Brexit risk being the no deal Brexit being off the table?
Right. On that point, Jill, these tentative agreements, I guess you could argue whether it's Brexit maybe, phase one, GM, you put all that together, does that mean the trade might actually be a positive catalyst for November?
It could. I think there's still a lot of uncertainty around, Brexit, around trade. So this is one of the reasons we've been expecting that volatility in the market is here to stay. But certainly, if we get a mini deal that on trade, that could be a positive for risk assets and for some of the multinationals and areas that have been hit harder by trade tensions. There's been several other positive catalysts into year-end. Earnings season has been holding up okay so far. The risk is just, as mentioned, a lot of the macro data, especially on the global and manufacturing front, has still been weak, hasn't really shown signs of bottoming yet. We do think this will be the one negative year-over-year earnings growth quarter for the S&P 500, and that will recover back into positive territory next quarter. And as we go into next year, the risk is just, usually when you see a negative earnings growth quarter, it doesn't just last one quarter when you look back historically. So really looking for some of that data to bottom out, which could be an encouraging sign for profits going forward.
The other thing, Joyce, that people are watching is weak volume. 3,000 is the magnetic pull of 3K.
Yes.
And now New York Fed taking repos to 120. I guess is volume and this repo squeeze going to be an issue for a while?
Well, every year we see year-end closing earlier and earlier, and I do think that you could get another test in December because a lot of the primary dealers will actually be, cutting some of their holdings as they report, their scores in. So we see two more easings still on the cards in October and in December, and the purchases resuming again. It's not QE, but it basically is making sure that the plumbing and the technicals are in a better position in the marketplace.
Jill, you said that misses are getting hurt harder than usual. What do you think that says about investor sentiment during this earnings season? And as you mentioned, the risk that, we do see subsequent negative earnings in the quarters to come.
Right. Yeah. Usually, when companies miss on earnings and sales, they'll underperform. We have noticed that misses have been generally getting hit harder than usual this quarter. I think investors are not yet willing to look through the miss if they don't become confident in the forward-looking outlook. So one of the things that we noticed going into this earnings season was that while guidance has generally been okay, you've also just had fewer companies issuing guidance and issuing forward-looking outlooks. We'll get a better sense as we get a broader and broader swath of companies reporting over the next week or two into the height of earnings season. But I think that those forward-looking outlooks are really going to be the focus this quarter, and that those price reactions definitely show how confident our investors that we do actually see that pickup in earnings growth next year, because expectations to us do seem a bit too high. Consensus is calling for around 10% earnings growth next year. We're thinking you'll see something more like 6%. But again, a lot of that macro data has yet to bottom out, or is just starting to show some early signs of maybe stabilizing.
Meanwhile, Europe is doing pretty well here. Stock 600 is showing testing some interesting resistance. Is there a chance that if the dollar starts to bend, maybe not break, but bend, that the U.S. dollar-denominated asset trade, obviously really crowded long, could surprise some people?
I really don't expect that, because I think the bigger picture question in Europe is on growth, particularly out of Germany, and whether they do some fiscal. So even though the earnings are coming in better, I still think there's talk about, do you have deflation risk in Europe? The slowdown is actually sharper there. So I think that, much as Jill said, though, earnings are going to come in lower in the U.S. We also think that it's going to be more like mid-single digits going forward. But I think the dollar strength is still based off of the growth differential, less off of the earnings. And the growth in Europe still is looking problematic.
We saw President Trump tweet about 19 minutes ago saying that the Fed is derelict of its duties if it doesn't lower the rate. Joyce, I know that you've been saying that lowering interest rates just isn't enough in this deglobalization environment.
Yeah.
Do you agree with that?
I mean, lowering interest rates is not sufficient. It's sufficient to prevent a recession, but it's not bringing back the growth. And we do see that 70% of the world's GDP, you now have monetary easing in place, but you haven't had the growth come back. So what is it going to take to awake animal spirits? And there's a lot more talk on fiscal measures needing to be used, particularly in Europe and particularly in Germany.
All right.
Resolution to trade disputes is stronger than monetary policy.
Well, and I think the trade uncertainty has been still seen as the key risk to investors. So they see something for phase one, but most people think this mini deal is going to be just that, a mini deal, that you've got these structural issues in place. And so the market had been looking at this as cyclical. Now they see it as structural. So I don't know if that's going to bring back the kind of boost that we're talking about with respect to growth.
Right.